Hello and welcome to Fintech Insider Insights. I'm Ross Gallagher, the head of consulting here at 11FS. For the last decade, neobanks have challenged traditional banks with better apps, lower fees and simpler customer experiences. And by almost every measure, they've been a huge success. Leading players like Revolut, Monzo, Nubank and Chime have attracted millions of customers, achieved profitability and become many customers' primary banking relationship. At the same time, companies like Robinhood and Klarna are expanding beyond their original propositions, signaling that the race to become consumers' primary financial partner is no longer just a battle between what we would have traditionally considered banks. But now the biggest challengers appear to be entering a new phase. Rather than simply replacing your bank account, they're expanding into investing, financial planning, AI-powered advice, lifestyle services, and premium experiences. In doing so, they're beginning to break down the traditional boundaries between retail banking, wealth management, and private banking. So today we're asking, are the traditional battle lines in financial services being redrawn? And what then does that mean for the future of the industry? Now, to discuss this really interesting topic, I'm joined by a great panel of guests. First, we have a very welcome return to the show for Maia Bittner, the investment partner at XFactor Ventures. Maia, lovely to be back behind the mic together so soon. Great to have you. Maybe you can just, I know you've been on quite recently, but you can just remind our listeners a little bit about yourself, reintroduce yourself.
Yes, of course, Ross. I have an entrepreneurial background, but big news on my side. I recently wrapped up 8 years working at Chime. So I really got to see Chime rise from being an ambitious challenger to operating at massive, massive scale. And then, as you mentioned, I'm now focused on investing and spending a lot of time on Twitter. So excited to chat about today's topic from all those angles.
Yeah, excited to have you, Maia, as always. And I think, given all of your experiences and insights, I think you'll definitely lend a lot to today's topic as well. So thanks for jumping on and sharing that with us. Also joining us, and another very welcome return back to the show, Ayelen Denovitzer, the head of operations at Formance. Ayelen, it's great to see you. Obviously, we did a show together at Money 2020, which was really, really enjoyable. Maybe you can, again, just remind our listeners a little bit about yourself and maybe some of the things you've been up to since then.
Of course. Thanks for having me. That was a really fun show. Quick recap. I'm head of operations at Formance, where essentially we provide the financial infrastructure layer to a lot of fintechs and financial services companies that surely are on the listening side today. And essentially the core of our product is a programmable ledger that powers money movement for these companies.
Love it. Awesome. Well, thank you so much again, Ayelen, for jumping back on with us. And then another old friend of the show, Matthew Ford. Matt, just back from paternity leave. Congratulations.
Thank you very much.
Again, it's great to see you as always. Maybe you can just reintroduce yourself to our listeners and maybe give a little bit of background to Sidekick and what you guys are up to.
Sure. Yeah, great to be on the show as always. So I'm the founder of Sidekick. We're a premium wealth manager. We're trying to take a lot of those products and services that a traditional private bank would offer and digitize those, drive cost out of those and open those up to a much broader segment. So a lot of the intro, Ross, that you were giving around how things are changing is very much top of mind for us because, we're hopefully very much at the forefront of the financial advice, AI question. We're spending a huge amount of time there. We offer a variety of different wealth products. So everything from private markets through to much more like customized, personalized investment products. So really trying to push the boundary on how do you take this archaic, expensive, very face-to-face manual premium service and how do you make that much more accessible and open rather than just delivering the same old commodity products, which historically the mass affluent have been stuck with.
Yeah, love it. And I think we're going to get into a lot of that as we sort of move through the discussion and the debate. So Matt, really excited to have you and sort of to get your perspectives on this stuff as well. I promised you an awesome panel. I think that's exactly what we have. So I think the only thing left to do is to dive right in. I think, Maia, maybe I'll start with you and something a little provocative to get us going. Do you think that maybe some of the language or vernacular around how we think about some of these fintech players needs to change. I mean, certainly when you think about some of the brands that we mentioned at the top of the show, the Neobanks, the Revoluts, the term challenger doesn't really seem to fit the mold anymore.
Totally. I mean, Revolut has 75 million customers and $2 billion in profit, right? Nubank has 135 million customers. It's like, if you have this many people, are you really a challenger? I think when you bring up the question, what does it mean to be an incumbent? Is it that you are the same scale or that you're behaving like an incumbent? And here's how I think incumbents behave. They have this big base of customers and they're focused on protecting their base and on monetizing the people that they already have, right? Well, I think challengers are more interested in they're growing, they're reimagining the roadmap, they're building out experiments on the edges of banking, things like that. And so the topic of our show is about how all of these companies are imagining new experiences. They're building, they're still growing. And so I think it's kind of on the line, they seem like incumbents by their size, but they're maybe not acting like incumbents.
Yeah, I couldn't agree more. And I think that's right. There's a mindset, there's a mentality that sets them apart. And it's not just growth at all costs, but I think for me, a lot of it comes down to that relentless focus. You could almost call it an obsession around solving for customer problems, and then how that starts to feed through into different, maybe less familiar propositions and offerings than we've typically been used to. I mean, Ayelen, I'm always really interested in your time at Revolut, because I think when you talk about players who are very, very good at sort of just like product development and pushing new propositions live, I think they're the standard bearer. I guess, do you recognize some of that in terms of what Maia was saying?
Yeah, absolutely. And I think what's interesting is that Revolut was definitely one of the most provocative challengers out there. And maybe, is it a challenger or is it an incumbent? Have we already set that this is what a bank looks like? Like, are we now expecting our banking experience to be like this? If that's the case, then surely they are no longer challenging, and this is like market standards or what we would expect from any provider these days. Revolut in particular, I think, hasn't settled. And maybe I go back to one of the values they have, which is don't settle, never settle. They keep on pushing the bar, right? So the speed of delivery for product is insanely fast. So you see launch after launch, some more successful than others. And maybe the strategy is a lot of testing in new bets, and some works better than other things, but for sure they keep that spirit of adding more and more as they see a need.
Yeah, no, completely. I agree with everything, but I suppose like the other nuance, and I think this is where kind of like the challenger aspect I think is interesting, is that like finance is one of like the oldest industries of time. Like it has been here forever, and a lot of the pain points and a lot of the reasons that new fintechs and challengers exist is to solve a problem that the incumbents have created. So, if you think about even Wise back in the day, it was getting ripped off by FX, or money is incredibly hard to move across borders, or whatever it may be. It was that these things already existed. Like money has existed for a very long time. Financial products have existed for a very long time. We're often not even creating new financial products, but the business models that a lot of these incumbents have sat on has just been like so profitable and often so misaligned with the outcomes of the end customer that for me is what the challenger bit is. It's kind of righting the wrong a lot of the time, and in wealth that is often just the fee ripoff. So I mean, I think that's the other thing. It isn't necessarily just about how fast you move, how agile you are, how innovative you are, whether you're playing with new technologies or not. It's like, are you actually attacking some of the core of the pains that the customers are feeling with those incumbents as well?
And Matt, I think when I think about specifically where you guys play at Sidekick, because I think obviously the fees are an obvious barrier, but I suppose when I think maybe where some of the root of some of those legacy problems around exclusion. I think it also maybe goes back to how we've traditionally thought about customer segments. And, I think it's been quite basic, right? It's been like, if you have a salary of X and have investable assets of X, then we'll talk to you. If you don't, we won't. And it feels like a lot of, the work that you guys are doing is maybe starting to democratize access and plug that kind of advice gap.
Yeah, completely. And some of it's structural. So, I mean, I think where we started was we said that there are these unfair advantages that a wealthy individual has access to with a private bank. So, a lot of that is product. So, private markets, more personalized portfolios, much smarter cash management, like actually really sweating the products, not just giving you a vanilla product, but really sweating them, making sure the tax efficiency works and all that good stuff. And like the exclusion part was just that if you're too small and you're not going to make us that much money, like we're just going to lift the limits all the way up here. So, private banks have historically needed about £1 million to get going. And even IFAs, so traditional financial advisors, unless you've got a couple of £100,000, you're just too small and non-profitable enough to be able to be interesting for those providers. So, where we started was, well, actually, how do you tackle that? Like, can you make the segment that is perhaps not as profitable and a little bit more expensive to serve? Can you make them a hell of a lot less expensive to serve? And if you can make them a hell of a lot less expensive to serve, then guess what? You can serve them, and you can build a really viable business there. So I think that was where we started, which was just like it's structurally often some of the limits, but where we're moving to increasingly. So what are the advantages of the financial of the wealthiest? Some of it is product, but actually some of it is just guidance and support as well. And again, a lot of it is just the fact that some of it's risk appetite. The banks got burnt by providing financial advice, however many number of years ago. So some of it's just risk appetite. But again, a lot of it just comes down to it's just as expensive to have a half an hour phone call with somebody who might make £50 off than someone that you might make £5,000 off. So why bother? So, I think that's our starting point is like, can you drive out costs? Can you digitize? Can you support like a segment that has historically not been addressable? And that's make it break it down.
I mean, the structure thing is totally key. And I think like the first wave of internet startups and things was using digitization and software to make things cheaper. And now AI is just like an order of magnitude making everything way cheaper once again, particularly on the personalization side, which I think we're seeing now come across with financial advice. And it's like, wait, if our costs get way, way, way cheaper, what does that mean for the landscape of people who have access to this advice and these opportunities?
Yeah, completely.
And I don't know, it's not just outcomes in the way that we maybe think about outcomes in terms of like micro outcomes, like I've helped this customer accomplish this task and get from A to B, but it's like it's life outcomes. Maia, is what you're talking about, right? It's like, how can you enable me to live better? How can you enable me to realize a better financial future and all of
Totally.
those.
People want to, right? They want better jobs. They want to buy a house. They want to pay for college for their kids. They have real tangible financial goals. And I think we are just now shifting from what you're saying, like the kind of small scale stuff. I actually think the first wave of challenger banks, there's this narrative that they improved on the experience. I actually don't really buy that. Like, Chase has a great app. I don't know if you guys have used the Chase app, but it's great. Like, it looks nice, it works well, it's fast, it has great information, it's responsive. I think they have a great digital experience. Plus, they have all of the in-person branches and those really cool-looking ATMs. So Chase is great. I actually think the first wave of challenger banks really did compete on economic impact, right? No overdraft fees, no minimum balance fees, getting paid 2 days early. That stuff has really tangible impact on consumers. I have heard thousands of stories about people who can buy formula for their kids because they got paid 2 days early when otherwise they couldn't. The average American pays $300 a year in bank fees, and with the challenger banks, they're not doing that. So that's very real. But at the same time, like, it's $300. Like, $300 is not going to let you buy a house. when you weren't able. Do you know what I mean? Like, it matters deeply and it is driving growth at the challenger banks and people care a lot, but it's not those big changes. It's not people starting to invest for the first time and seeing that passive income. It's not, really that progress along financial milestones that a lot of people are looking for.
Ayelen, would you agree with that? I think it would be ridiculous to suggest that we haven't moved the needle. And I think, even culturally, I think an impact of the challengers and the success that they've had is, I think, culturally, even right into all of the big incumbents, I think we have seen a shift away from just thinking about along the traditional lines of what it is to be a bank and sort of pushing things much closer to the customer. But Ayelen, do you feel like we're sort of making progress in terms of realizing or helping customers achieve some of those bigger outcomes, or were we really just sort of scratching the surface?
No, for sure. And to be honest, I don't know much about the Chase experience, so I'm not going to get into that. But at least in the UK and Europe, so if we time travel and go I don't know, 10 years back, the banking experience was not amazing, right? For a lot of things, you needed to go to a branch. The range of products that you would have with your traditional bank was quite limited, plus really expensive on specific products, right? And now we take for granted that we have this very wide range of products on an app. You have support, clicking on help, and you get things sorted without going anywhere. There's been a massive consolidation of products that maybe you needed different providers to get access to those. And now you have there's just a lot of stuff happening in every of these apps, right? I do have a bit of a bias with Revolut, but again, it solves a lot of your problems. So it's not just, it covers, and that's the whole mission, right? Like covering virtually every aspect of your financial life. So I think it changed what we're understanding as a bank. And maybe, 10 years ago, it was a challenger. Saying Revolut was like, we're never going to be a bank. And today they are. And all of these challenger banks or these super techy startups that got into the financial services market, they are all regulated and they all are banks. So I think the definition of what a bank is has changed massively.
I completely agree. And I think there's the what you do, which I think is your point about you're a bank because, you have a banking license, you operate within financial service and it's tightly regulated. And actually there are pretty strict definitions around what it means to be a bank. But then there's also the how you do it. And I think the how you do it for me is where you're really starting to see some of that differentiation. And I think particularly when looking at Revolut, I mean, the way that they're starting to just sort of push out of traditional financial services into travel, and they've got the rev points and all of this sort of stuff, and the crypto, and now you're starting to see what they're doing around AI. I mean, all of the potential for all of that sort of stuff is huge. Of course, as well, Ayelen, to the point that you made, of course, we're starting to see them all now build out different products, starting with that small niche, whether it was Wise going after the expensive overseas transaction fees. But of course, now they're all building out beyond sort of classic current accounts into investments, into credit cards, personal loans, all of that sort of stuff. But again, Matt, I think the thing that stands out for me here is if you look across the landscape and you look purely at what they're doing, then maybe you're not seeing a ton of differentiation. But I think, again, when you look at how they're sort of doing it, it's not necessarily the same.
Yeah, it's a stage of the market that we're in as well, because it makes me sound very old, but the first startup I worked at was called OnTrees back in 2012. And we had a mobile app and it was like, whoa, the banks don't do mobile apps. Like literally all we did was you got to see your balances and your transactions within a mobile app. And that was 2012. And like by 2014, 15, all the challenger banks were coming. So there's like time and place. And we're at like peak maturity at fintech. Like genuinely, I remember how hard it was getting PIN block unblock, pin view and card block unblock like back in the day. It all sounds completely ridiculous now because it's all a massive commodity. But like back then, features did really matter because it was so terrible. It was so terrible. Even being able to see what you had in what account and see it with an up-to-date balance was like a problem 10 years ago, and they went and solved it. Fees were a disgrace, and they went and solved that. But now we're just at a different stage in the market. So yes, incumbents have caught up because technology's got better. Some of the features were never enduring moats. They were reasons for people to initially shift, and everyone's caught up. But the
features and the fees. I don't know if you've seen this huge wave of banks in the United States, at least, have eliminated their overdraft fees. And I really think that is due to competitive pressure from the challengers. And that is a huge win for the American consumer. It is not right. It's like, okay, now they don't look as good in comparison because they're not charging overdraft fees like everybody else. But they've changed the whole industry. So few people are being charged overdraft fees. And I think it's because, the banks, the incumbents, they need to catch up. They need to catch up with features and with their fee structure.
Yeah, completely. But I think like one thing I'm always really fascinated about is there's this concept of deflationary economics, which I think is where challengers will always win versus an incumbent. Because if you think about incumbents, they had these huge profit pools across lots of different areas. Those have been attacked. So whether that was stock trading, overdraft fees or whatever, those have been attacked. But the incumbents, they have offset that with better digitalization, so lower cost of branches and stuff like that. So they basically just moved the cost and income structure around slightly within the organization, and the net result is kind of a little bit better. But deflationary economics is like really the main asset of what Revolut and Co. did back in the day, which is if you basically destroy a market, so you've destroyed the market for FX, or travel abroad fees, like you've destroyed that. But then what you do is you reinflate the market on a completely different axis. So, like Revolut basically took billions of pounds worth of money that was foreign spend fees, made that a zero market, but then started charging for lounge access. And if you kind of then reinflate on an axis that an incumbent is never going to be able to kind of ultimately go and play in, those are super, super interesting. So I think that's why you've kind of seen this weird world where basically there's lots of these profit pools that have just been collapsed. But now, because so many of those have been picked off, and by the way, I think financial advice is the last profit pool that needs to and is getting slowly started, it will start to be attacked pretty soon. But most of them have now been attacked. So this is why you've now got this harmonization across everybody, because they destroyed the incumbent profit pools. Now it's about how can you aggregate and get more and more and more of the other stuff to start to monetize in lots of other different ways.
That is such a smart way to think about it. I've never heard it described like that. And I think, when you talk about, I think consumers really almost over focus on specific angles when they're choosing who to do business with. And so by making those as attractive as possible, right? It's okay. And then it's nobody's picking their bank based on lounge access. Or maybe they are, but they get to make money in smart ways. I have a local bank here that I adore, and they offer a crazy high interest rate. It's 7% or 9% or something on your first $2,500 in savings. And I think angles like that are really smart because people really like to choose banks based on their savings rate. But it's actually very cheap to provide a high interest rate on a small amount of money. Mm-hmm. And so they're kind of shifting. It's we're looking at how do people choose who to do business with. And just what you're saying, Matt, it's but you still need to make money somewhere. And so you've got to move this stuff around and be really strategic about where you're making money and how you're acquiring customers. And those might not be the same way.
But what I love about that example is it shifts your revenue model away from, forcing customers to pay fees away, like towards here's some value that we're going to give you.
And I think you choose the lounge access. It is optional.
Correct.
You are not tricked into it or strong-armed into it or pushed into it out of desperate financial circumstances. You just like 100% opt into that.
And you know, when I look at Revolut and how they've designed their subscription, like their packaged account products and the tiers, I think it's the best illustration of what I was saying earlier about the difference between the what and the how, because they have a different brand permission to other banks and their competitors playing in that space. And I think it's best summed up by like, what other bank could offer to cover the cost of your annual Tinder subscription? And you would be like, yeah, I'm going to go for that, right? There's just no other bank that can do that. But it's also when you sit down and you actually look, you break out all of the value that you get from each one of those tiers. There's a ton of value. Like one of those tiers where you're paying, I can't remember, right? But it's in like it's like 15 or 17 pounds a month, includes a FT subscription, which you would never, would cost you more to just get that by yourself. And that's just one of the options. And again, it's Revolut using their size and being able to negotiate really good deals for their customers. So it's like value over just cost to, make an overseas transaction, which, from again, just value to the consumer is a completely different thing.
Although I think if we had someone from the incumbent banks here, that they would argue that overdraft fees are providing value to consumers because they're letting, blah, blah, blah. You can spend more money than you have access to, helpful in a pinch. But yeah, I'm not arguing that.
All right. I am going to take us to a break, and then we'll be back with you very shortly. Welcome back to Fintech Insider. Now, before the break, we explored how the biggest neobanks have moved beyond competing on better banking experiences. Now let's look at what that expansion means for wealth management and whether capabilities once reserved for private banking are becoming accessible to everyone. Historically, personalized investment advice, financial planning, and concierge-style services were reserved for affluent customers. Today, we're seeing these capabilities become increasingly accessible. Revolut Wealth, Clio Autopilot, Robinhood Cortex, and Publix Alpha are just a few examples. But Matt, obviously with your experience, which you've already talked to in some detail, building out Sidekick, I'm really keen to get your thoughts on sort of direction of travel here and where we're headed.
I mean, we've learned a lot. Where we started to where we are today is pretty night and day, I would say. And I kind of alluded to it earlier that I think that there's two distinct problems. So one is just getting access to more products that can achieve better financial outcomes is always going to be a good thing. And a lot of those things have been locked away. So private markets, not for everybody. Private equity, it's not for everybody, but it can play a really good role for some within their portfolio, and most people have been locked away from that kind of stuff. So I think the market has been on this kind of traditional fintech way, which is like you break the box apart. So, you had hundreds of companies all trying to democratize private markets to some extent, or you had loads of companies trying to democratize auto saving or, challenge a traditional robo-advisor with lower cost, ready-made portfolios and all those types of things. So the box got broken apart. But I think like where we're now the most excited is that we've almost kind of caused a problem for ourselves in some ways, which is now these things are available, but like, what the hell do I do? Like, how do I navigate that complexity? Money is complex, but like wealth is particularly complex because what are risk-adjusted returns? Allocation drives everything, but how should I allocate? How do I even think about what I want to achieve in life? It's not as simple as like, I have a savings goal for 3 years. Like life is messy and muddy. I have lots of like behavioral traits, which means I do really stupid things. We all do. We buy high, sell low, all that stuff. We panic when the markets move. So there's all of these things now that if you give people the tools and give people the weapons, they're still going to make pretty poor choices or be really overwhelmed by what choices they should make anyway, because it's just cognitive load and complexity. So like, I think the market's in a really interesting space. And I would say this because I'm building in this space, but like we've all been trying to blow it all apart and there's some really great options out there. Now it's about trying to not rein it back, but actually help people use these tools now that are available to them to achieve the great things that they need to in life. So for me, the financial advice is the final boss. It's the bit that the banks got scared about. It's the bit that we're all a bit scared about because the bar is high, the risk is high, the opportunities to be sued are very high. You've got to get this right because it is people's real money. But technology, AI is helping. AI is not the magical answer that is, not everything is at the end of an LLM. But, the tools, the technology and everything is now there to, again, going back to that kind of open up, drive out cost, make these expensive, operationally complex things much more open. Like, that's where we're betting on, now for the next 2-3 years is that we've got the tools in place and now let's go help people make the most of it, basically.
Maia, I could see you sort of going back and forth between like frantically nodding and then very pensive. So I'm interested in your reaction to, the sort of the world as Matt sees it.
I mean, I have so many thoughts on that, right? Matt is talking about private markets, and he says they're not for everyone, which is true. I mean, the government, right? So like at least in the United States, you have to be an accredited investor, which means you either have enough money or you've passed a test that says you have enough knowledge to do this incredibly risky type of investment where it's very, very easy to lose all your money. Like the whole difference between private markets and public markets is that public companies are very regulated in the information they have to provide and how they operate, so that it's hard for people to be bamboozled and lose all their money without thinking that they're going to. And so I think when we talk about democratizing products like that, like private markets and private equity and investing in those things, it is pretty scary. It's not that the incumbents have chosen not to offer those to everyone. It's that the government has chosen that maybe it is too scary. So I do have a lot of concerns on that angle, and that's what Matt is saying with the advice piece being the final frontier. The other thing I was thinking through is, I've been talking about fintech for a long time, right? And I go on the podcast and I go to Money 2020 and Fintech DevCon and blah, blah, blah. And one of the pieces where I have really deviated from the industry for the past 10 plus years is on financial advice. I've been anti-financial advice. Everybody is into financial advice and education. They're like, we just need to educate people, and people don't understand what compound interest is, and they don't. And I'm like, they do not need financial education. It's not going to work. And the reason I don't think financial education works is because the 90% of financial education, or 80% that applies to everyone, you can write the blog posts and you can send the information, but the details that really matter is that last 20%. AI changes that. I am shifting my whole stance to be pro financial education now because AI can do that last 20% and truly personalize it based on who you are, the zip code you live in, your personal circumstances, the money you make, that you've got both a W-2 job and a 1099 job, and you're trying to cobble together different sources of income, and you've got these interesting expenses things, and you want to tax optimize, and you want to grow your wealth, and you're worried about these risks. It can handle all of that and actually give you a pretty compelling answer. And so I'm quite bullish on AI driving the cost of financial education to zero, that personalized financial education. Same thing with personalized health. Personalized to zero and bringing it out of the big like private banking.
Sorry to interrupt there, but massive difference between financial education and financial advice. So I completely agree with you that the problem with financial education is even if you make it more engaging and more compelling and more palatable, it's still education, which takes time, which takes effort, which is very, very, very hard to educate a whole market on very, very, very complex things and ensure that people fully comprehend it. Financial advice is almost the opposite though, which is just like, we will help do this for you and take you along the journey. So this is why I think it is the final frontier, because everything else was about let's write more blogs about how to invest, let's just kind of like build the knowledge base. But all of those things I was talking about, which is like we have behavioral biases, we do really stupid things, we're fighting against our own kind of species. Like as a species, we do irrational things. This is where the role of an advisor comes in, which is a real expert whose only singular job is to understand this stuff and help you navigate it and help do it for you. The problem historically it's just been inaccessible, and it's super, super expensive. So I think AI can play a massive role on both sides of it, but I would just hazard of bundling education and advice in, because I think they are very, very different pieces ultimately.
Yeah, it's fair.
I agree. I think there's levels to all of this, and I mean, Matt, I couldn't agree with your point more about we all like to think of ourselves as these perfectly rational beings, and we're not. We all have what would be considered by a rational being, like poor financial habits and behaviors and all of that sort of stuff that is probably undermining our financial goals and where we're trying to get to. I think when you look at things like the autopilot tool that Clio's rolling out, and Maia, this probably goes more to what you were kind of saying around like, look, we'll understand your financial reality. We will understand where you're trying to get to in terms of your goals and objectives. We will set you a plan that will, sort of get you there, but then we'll continue to reevaluate. So as soon as your personal circumstances change, then we'll make sure that the plan is up to date. I mean, when you compare, for me, something like that and versus where that sort of thing just didn't exist before, you can start to see how over time individuals can start to realize a much better financial future. Ayelen, I'm really keen to bring you in and get your thoughts. Can you start to see a path to where maybe some of those traditional barriers or silos for private banking and wealth management start to get broken down a little bit?
Yeah, so super interesting point of view here, right? I have so many thoughts. I'm trying to organize those. But I think a couple of things. I think it's very different if you're deciding so again, taking Cleo's, right? It advises on small things, right? It's not advising if you should or should not get a mortgage. And I think that's where it's easier to apply AI and take financial advice from AI and be comfortable with that versus when you're making a life decision and involving a lot of risk, potentially taking a lot of debt or putting a lot of money down as a payment. On that type of situations, again, we are irrational, we are emotional creatures, so we still see humans needing a human interaction. It doesn't mean that someone needs to call me on the phone, but I'd be slightly skeptic if we are from saying that we're 100% ready to take advice from a model on buying or not buying a house. Again, is it right or wrong? I'm not discussing. I'm just saying we are emotionally rational creatures that would struggle to not have anyone to make accountable or responsible for part of that decision. And then I would also split. So that's one point. The other point, and sorry to hijack this bit, I would differentiate things that are purely native private banking and wealth management. So I think that what's been happening is we have now better tools for deciding on, again, small-ish investments, planning, understanding our expenses. There's tons of data. And for those bits, I think AI is great. But then part of the core of private banking is that it gives you access to something that it's genuinely scarce. So you have access to something there's not much of. So I'm trying to reconcile, okay, if you're giving access to something that is super scarce, how is that operating in a mass market? You know what I mean? And maybe Matt, I'll throw that to you, maybe.
Yeah, I think it's the human relationship ultimately. I think you kind of said it a little bit earlier, is when it comes to money, as much as I've been in the fintech space for such a long time, I like to pretend that everything should be through an app and digital and fast and remove friction and make onboarding faster and slicker and more digital. People, when it comes to money, trust no one more than another human at the other end of it. And, that is the premium, scarce resource that has always been at the other end, which is like a true, real expert. And you can fast forward this even within private banks themselves, because, if you got £1 million, sounds like you're doing quite well in life. You are doing quite well in life relative to the general population, but you're still not getting the real experts. The real experts are managing people who've got 200 million, 500 million. So there's still shades of this as well. But no, I mean it's the human interaction piece, and we are running at this problem very, very hard at the moment. So we don't provide financial advice today. It is our ambition in the near future. But AI can do a lot of like the admin side of the role that meant that human interaction was scarce. So if you think about the role of a financial advisor, they spend their life setting up meetings, replying to emails, drafting pretty boilerplate suitability reports, doing soft fact find checks, hard fact find checks. These are pretty like generic tasks that agents are extremely good at. But that is not what financial advice is. Financial advice is then the final mile and the human interaction and all that good stuff. So I think AI can actually just take out 80%, 90% of the work that an advisor does to then free up that advisor to service 10 times as many clients. So I think that's where we're most bullish. I don't see a world, and there's the Mills review out recently. I don't see a world. I don't know why we would see a world either where an LLM, which by definition is guessing the next best token, is the answer to regulated financial advice. But it can be a really great tool to obtain information, to do a fact find, to do a few of these things. And then you need human accountability at the other end of it, and you need a human relationship as well. So, yeah, I really do think AI is going to completely revolutionize financial advice, but I think it will revolutionize it by allowing humans to have more interactions with humans, which is ultimately, I think, what I'm most excited about.
And that point that you made that's so true is, that if you get that blended model right between humans and AI, then the model scales, and it scales way beyond where it is today, right?
Yeah, completely.
It's interesting in terms of like, I don't know, Maya, it'd be interesting to get your thoughts in terms of like direction of travel. How ubiquitous can this become?
What AI financial advice, you mean?
Well, I mean, in terms of like, can we move to a world whereby, we all know about the advice gap today, but can we move to a point where we've almost closed that off?
Oh, I really hope so. But it's also not a one-size-fits-all problem. So, if I was to take my critical hat and almost be like Wise of 2014 and say, the incumbents are shocking, let's go and run at their profit pools. At the bottom end of the advice market, there are a bunch of people who have essentially very low confidence, very low financial confidence, who have quite basic financial decisions to make, but want a human to do it for them because of that low level of confidence. And they're getting ripped off often for pretty basic stuff, which is like fill your ISA and put whatever's left into a pension. And they're paying an absolute fortune for that. And I think like that end of the market can be like, you don't need an LLM for that. It can be pretty deterministic in the way that those types of things are done. And I think technology can really go after a bunch of that market. And this is where probably like the money boxes and those types of businesses are going to run really hard. Is that they're just going to make that sort of like low level regulated financial advice, but simple financial advice, much more easy, accessible, open. And I hope a lot more people are able to step into that. The further you go up the funnel, I suppose, of complexity, where trust structures and complex financial situations and all of those types of things start to come in, I think that's where like basic models start to break. And I think that's where like the real human kind of advisor relationship and, that deep complexity that they've built their career on, that's where like it's less about fees really at that point. Of course, you should be paying fees for really complex decisions. But that's where they're going to earn their fees, because they're actually going to do some really complex work and like really earn their fees for it. And you're not just filling your ISA at that point; you're unlocking thousands of pounds worth of either tax efficiencies or losses that you would have had in other ways. So, yeah. So what I hope is that more people take that simplified approach, and that fees are driven out as much as they can be, and then more people who have more complexity at the top end can get access to more financial advisors. And I don't think necessarily fees are going to disappear at that point, but the accessibility of those services is going to open up much more broadly. So
I think Matt is really right. And, when I look at the like popular financial advisors who have TV shows and podcasts and books and things like that, like Dave Ramsey, they often have really blunt advice. Like Dave Ramsey says, no debt ever, no mortgage, no debt to buy a car, no debt to no college, no debt ever. And it's like there is a certain person who this is really good advice for, and they really need to hear no debt. You cannot take on any debt. There's no excuse. If you have debt, you got to get out of debt and pay it off. That is really valuable for there is a certain type of person. And then there's a lot of different financial advisors. I don't know. I follow Remy on Twitter, and I really like his stuff, and I listen to his podcast, and they've all sort of got an angle. And kind of what Matt is saying is for the low confidence consumer, right? It doesn't need to be that sophisticated to be really valuable. And I really wish, I think it would be really cool if all of these financial advisors had their own apps with someone's specific personalized data, and you could get Dave Ramsey's personalized advice for your financial life, sent to you and push notifications, and you should not have spent money. It's just really cut and dry and clear. Do not spend money here, pay down this debt, do spend money here, work on your income there. And it's just, there's no room for negotiation. I think that would be really helpful for most people. And I totally agree with the way that Matt's sort of segmenting the market. There's a big group of, higher confidence consumers that doesn't apply to, but it's a really good fit for LLMs. And when you look at the numbers, it would help so many people to sort of bring them up to the next level of financial stability.
Yeah.
Where I think LLMs are powerful is the discovery stage. And I kind of, being a new father, so 2 weeks in, 2 weeks today, you should look at my Claude history, because basically from a medical perspective, there's about 500 chats open of, is it normal if baby does this? Is it normal if baby does that? Is it normal if baby does that? It's actually hilarious kind of looking through, because you're like, oh my God, is this some paranoid new parent? But actually, it's really powerful to surface, because you could Google those things, but there'd be a blog and there'd be conflicting advice and all this type of stuff. It's a really great way of building confidence, breaking down complex things, navigating things really effectively, that discovery side of things. If my baby was really not well, I'm going to pick up the phone to a doctor and get him into A&E as soon as possible and get the expert in front of them. And I think you're going to get exactly the same within the financial advice space, which is I think ChatGPT, Claude, whatever, it has dangers because it's going to tip into, and it already does tip into, regulated financial advice. But it can be a really great discovery tool for just building a bit of confidence, asking some simple questions, breaking down some of those barriers. It isn't this wall of terror that I don't know anything about money, so I'm not even going to engage with it. It's going to break down some of those early barriers and do some of that early discovery type stuff. But it's that handoff then to when you've gone from discovery, information, fact find, kind of building a bit of confidence to, but now I need an expert, and I need that to be auditable and repeatable and transparent.
I do think, there's the regulation piece and the liability piece, but I do think AI is going to creep higher and higher up that stack of what it's able to do. Because if it's able to see all of your transactions and it knows everything, it is going to be so much better equipped to be giving you real-time financial advice about your situations that people will build more trust. If you're asking ChatGPT, is it normal for your baby to poop 25 times a day? The answer is kind of yes. Right. It's if ChatGPT or AI had real-time monitors on your baby and knew all of its vitals, or it pulled in all of these things, or you've got the owlet sock.
Now it's getting creepy.
And well, it is creepy, and I don't know that I would want that. And there's a bunch of it's creepy, but pretend it's not creepy, or you're running a local model on your computer, and so the data's not going anywhere, or something like that. And it was able to send you push notifications that said, "Hey, we noticed." Actually, I think Nana does this, right? We noticed that the oxygen level of your baby has dropped a little bit. Go check in on. If it could send you that. That would be so valuable. It would be so amazing to see that the blood oxygen levels have dropped a little bit, and you need to check in on your baby, that you are going to trust that system more and more. And it's actually going to be better than a doctor, because a doctor is not going to be looking at all of the data every second. Does that make sense? The scale that it can operate at. So I think financial AI is going to get the same way. It's going to get more and more equipped with all of this really fine-tuned data that's changing instantly. consistently, and it's going to be providing more timely, more contextual, more helpful recommendations than advisors can, like very slowly creeping up over time.
Just because it can, should it, and will it be allowed to? Because like I'm telling you now, like the UK regulator is they will start coming and clamping down on this stuff because they need, like, the basis of regulation is accountability, human accountability. And like like technology is amazing. Technology can do amazing things, but like the limits of technology are often not the limits of adoption. It is regulation. It is all of those types of things. So I think we also have to ground it in the reality that if the regulator is all over this at the moment, and it is going to be one of the hottest topics, I think, of the next year, of like what are the model providers going to be allowed to do, not just what can it do, because they can do amazing things and reduce hallucinations to 1 in a billion. Like, of course, it would be able to do that eventually.
Ayelen, final word to you on this.
So just like we all reacted and say, oh, that's creepy, like I wouldn't share that information, I think people can feel the same way about sharing their whole financial life. So the model is just as good as the data you input in. So if there's an emotional side and you're not sharing, I don't know, you're ashamed that you spent X, people do those things, right? So the output you're going to get out of a model is only as good as whatever you put in. And having the trust to actually say, like, oh, I'm going to be completely open, and I trust that when I share all of it, my deepest financial secrets to this model, then I'm going to get a good advice and I'm going to take it. I think that's the barrier. And on top, the compliance bit, right? This is super regulated. But even without the regulation, I would like for a second to compare our reaction with the baby data. And I think people would behave in a similar way. Maybe they're more prone to sharing or getting advice on day-to-day spends. And progressively, we're going to get there and people are going to trust it. But it will take time, I think.
I feel like it's progressive for sure. But I think we're all aligned behind. I think whatever the route, there's definitely, you can plot a path here to a much better customer experience, much better customer outcomes. I think that is a great place to end. Thank you as ever to our guests for joining us today. Before we go, maybe we can just do a whiz around the virtual rooms and you guys can tell us a little bit more about where people can find out more about you. Maia, how about we start with you?
Oh, always Twitter. I'm Maia B, MAIAB on Twitter, and I'm posting all kinds of stuff about having toddlers and fintech and working remotely and that fun stuff. So yeah, it's the best place to keep up with me.
And still refusing to call it X. Good. Ayelen, how about you?
Yeah, you can find me on LinkedIn. Old-fashioned, I guess. Hopefully my whole name is going to be written because I'm not going to spend 10 minutes spelling that.
Excellent. Thanks, Ayelen. And Matt, how about you?
Yeah, same. LinkedIn, but also Sidekick. It's at sidekickmoney.com. So yeah, check us out.
Perfect. And you can find me also on LinkedIn. And thank you for listening. If you like what you've heard, please do follow our podcast. As always, if you want to join the conversation, find us on social media. Just search for 11FS or Fintech Insider or email podcasts@11fs.com. Thank you very much again, and goodbye.